What's going on, guys? It's your boy Trillionaire Mac. Welcome back to another video. I have missed you guys. I have missed uploading to YouTube. This week we have a lot of good content coming for you all. Towards the end of the week, there will be a video dropping today, which is Wednesday. Tomorrow, which is Thursday. Friday, there will also be a video dropping. And then I might do two videos today for you guys on some trades that went through. Using the same style of teaching that I teach my students here at Matrix Trading Group. And those of you who have purchased my institutional trading course to see the market exactly how I do, take advantage of these setups exactly how I do. So in today's video, we're going to be breaking down gold. There were a couple of entries that took place. We're going to calculate all of the entries, return on investment, as well as I'm just going to show you guys kind of how I take advantage of the charts and things like that. For those of you who have been watching the YouTube content for quite some time, hopefully you can see now how all of my trades literally look the exact same. Okay, so that should prove to you guys, all right, not only is this a profitable style of trading, but it's a mechanical style of trading, right? There is no user discretion, right? You don't have to think, you don't have to feel, you don't have to do anything but check something off the list and then move forward with something, right? They're simply just if-then statements. So we're going to break this down from top to bottom. I'm going to go over all the entries, and maybe we can see, what we can expect next. All right. So with that being said, if you're not already subscribed to the YouTube channel, feel free to go ahead and subscribe. A lot of new content coming soon in 2022. Okay, super excited about that. We'll be doing a podcast. We'll be doing live streams where you guys can call, ask me questions. A lot of new stuff coming. I'm not going to say too much. So if you're not subscribed, go ahead and subscribe to the YouTube channel. Hit that bell notification icon to be updated whenever I upload a new video. Okay, and if you enjoy this content, if you enjoy the longer videos, feel free to leave a like on the video. And with that being said, let's go ahead and get right into it. As we know, okay, I always like to start off on the higher time frame as it relates to the H4. Now, as it relates to the H4 time frame, right, originally, okay, and this was last week, originally I wanted to see price tap back up to and back into this area here before pushing to the downside, right? Like that was my first analysis on everything. Okay, so we see price came very, very close here. I also sent this to students and clients within my Telegram community. Okay, and keep in mind, guys, I'm not trading as much in December. Okay, I don't trade as much in December. But when January starts back up, we'll be back to the normal schedule, back to the normal trading schedule, uploading schedule, mentorship schedule, things like that. All right, so definitely keep those things in mind. But anyway, so we wanted to see price tap back up into this area before pushing to the downside. Okay, simply because we know that we're at some type of level of demand here. Okay, and when price was up here within this area, we knew that we also had demand down here that price could essentially tap into in respect or tap into in disrespect. All right. So I was looking for sells all throughout this area here. So we see we had a break to the downside, breaking structure here, okay? This wick here is what I would use and what my students use to find supply that's within the market that was responsible for this break of structure here. Okay, I'm not really going to explain why I would use this wick here, but if you're part of the mentorship program or if you have access to the institutional trading course, then you completely understand why this was my refinement for this area. Okay, so price pushed to the downside, gave us a break of structure, tapped into demand, created a failed reaction, and then continued to push to the downside, giving us another break of structure. Now, with this second trade, okay, I really wasn't looking to take advantage of this here, okay, at first. Okay, this here, when price taps back into this here, I wasn't really looking to take advantage of it at first, all right? And I'm going to explain to you guys why. Now, the reason why is because we see that price break structure here. Okay, and pushes to the downside. We see that the supply that came into the market that was responsible for this overall push to the downside with this nice bearish candle here. Remember, ignore this wick here. This was news that was released, but we did not get a candlestick body closure. So it's simply just price movement. Could have been a sweep of liquidity for price to continue to push to the opposite side. But as we can see, supply came into the market to completely take out any demand that was swept here with this wick. All right, so we have a lot of bearish pressure coming off of this here. All right, a lot of bearish pressure. So once price pushes back into this area, I'm really looking at all of this as liquidity. Okay, at first I was looking at this as liquidity. when price tapped back into this area here, I was looking at this as liquidity, and I did not stop looking at this as liquidity until we had a shift in market momentum. So now that we understand where our supply and demand is, where our breakup structure, why this was an important area to me, let's go ahead and explain why this here is an important area. So if we're looking at market structure, okay, which is something that I really pay attention to, remember market structure is king, okay, at the end of the day. It trumps liquidity. Liquidity is just a confluence, but market structure is going to show you who's in control as well as supply and demand. But market structure, I would say, shows you a little bit more on who's in control over supply and demand. All right. So we can see that we have a lower high here. Okay. Then price decides to push to the downside. All right. We don't yet have a breakup structure with this area here. Okay, so essentially price creates, we can just say price creates this low here, create a lower high, tested low, remember we're going to ignore this wick, tested low, and then price pushes to the upside, and with this wick here creates a higher high, but with our candlestick body closures, still creates a lower high overall, then we push to the downside and create a lower low. All right, so now we are working within this range here. Here's the high, and here's the low. All right. Then what does price do? Price creates a lower high here and then another lower low. Okay, so we had a breakup structure continuing to give us bearish momentum. So when I see this, okay, when I see this second breakup structure here to the downside after creating this lower high, okay, that tells me that we could possibly have some type of interest within this area when price comes back, but it's not confirmed until we see certain confluences. All right, let's go to the H2 so we can see a little bit more detail while breaking this area down. All right, so if we're looking at the H2, we can see that price comes right back up, right below our point of interest here that was responsible for this breakup structure here, okay? The supply that came into the market within this area here, okay, which it's refined to the H4, so on this time frame here, it looks a little wacky, okay? Just keep in mind that this refinement is on the H4 time frame. All right, price pushes to the downside, creates this lower low, taps back up into this area, and creates liquidity inducement essentially for price to continue running higher. Okay, now remember, I do have an inducement video for you guys, but just a quick little rundown. Let's say we have a breakup structure with this push to the downside here. Let's say we have supply that was responsible for that breakup structure here. And let's say price trades back very, very close into it and then trades away. This means that there is liquidity resting here that price can later collect, okay? And it'll allow price to fuel the opposite move the other direction. All right, I know I went through that kind of quickly. Feel free to check out the inducement video that is on my channel, released a few months ago. But if you just go to my YouTube videos and you go from view count, okay, most popular, you should see it somewhere within the most popular videos. Okay, so we have inducement here, then price creates a low here, and then essentially we sweep this inducement here. All right, so we sweep this inducement here, giving us a breakup structure to the upside, okay? And then essentially supply comes into the market that fuels this change of market structure, okay, creating this lower low here. All right. Now I know I went through that kind of quickly. Okay, if you need to rewind the video, of course, feel free to go back through that. But essentially, where's my marker? But essentially within this area here, this would be our sweep of liquidity. We swept above instigated liquidity here. Okay, we tapped into our supply that was responsible for this breakup structure here. Okay, and then we also get a change of market momentum with price giving us a bearish candlestick closure here. All right, so once I saw that, okay, I had this point of interest that you guys can see here. Let me actually change that. Okay, I had it refined slightly different before I went down to lower time frame to refine it even more. So on this time frame here, this would be the point of interest that I would be looking at to take a sell order from. Okay, now remember, valid macro zone, valid micro zone. Valid macro zone is going to be for you to find your higher time frame zone. Valid micro zone is going to be the area that you're going to find, or excuse me, valid micro is going to be the area that you find your entry. Okay, using the correlated equations that we talk about within the institutional trading course. Okay, for those of you who don't know how to correlate time frames properly, of course, just feel free to contact me and I will either direct you to the specific area that I talk about correlating time frames, or I'll just give you the equation if you're, of course, a student or a part of the institutional trading course. All right. So in this case, I wanted to find my valid entry on the M12 time frame. Now, if you don't have the M12, using the M15 is completely fine, especially given as though we pulled most of this off of the H4. So you could definitely look for your entry on the M15. Let's actually look at the M15 first, actually. Might as well. Okay, so when price taps into this area here, okay, it gives us something that we can trade from in the future. Okay, let's go ahead and mark this up. Now, students of mine, you guys already understand what I'm doing. Okay, based on the higher time frame, we have pulled into an H2 point of interest. So what we can do now, let's look at the H or the M12 really quickly. Yeah, let's use the M12 in this case. Just gives us a little bit more information. So here we see that sweep of liquidity here. Okay, we see that break to the downside after we have that sweep of liquidity. All right, let's go back to the M15. You know what? We're going to use the M15 because I'm sure most of you guys use the M15, and I'd rather use this time frame so you guys can go ahead and mark this up on your charts as well as practice. Now, with this style of trading, it really just takes a lot of patience. You have to wait on your levels to get hit. You have to wait on your expectations to follow through before you actually act within the market, which is the most difficult part in my eyes, right? How I trade is very, very easy. Okay, the most difficult part is you sitting on your hands, essentially. Okay, so this was the apex. Let's change this to supply. Perfect. So this was the apex supply that was responsible for taking out this demand here. Okay, so in my eyes, what I'm waiting on is I'm waiting on price to trade back up into this area here, and then I'm going to look for my entry schematic. We're simply just correlating the time frames together. Okay? Refine this down to the M15. Now we have a valid point of interest here. All right? So now what we're going to do is you can either do one of two things. You can take your entry based on the M15, okay, straight up, meaning you can take your entry here, okay, which is completely fine, and your target easily this area here for around 7.44%, okay. That's one way you could do it, okay. But how I like to do it is I like to correlate a little more. So I like to take my entries on the M5 or the M5 time frame, or the M1, excuse me, if I'm intraday trading. So M5, M1 if I'm intraday trading. If I'm trading based off the higher time frame, then I will stick to the M15. Okay, neither are incorrect. Okay, it's simply just how you see the market and how you like to take advantage of price. Okay, so if you're more of an intraday trader, feel free to use the M1 to take your entries. If you're more of a swing trader, feel free to use the M15, M12 as your entry. If you're somewhere in between intraday and swing, okay, then M5 is absolutely perfect. So in this case here, once again, instigated equal highs, okay? Price always does this, especially with gold. So we have instigated equal highs here, okay? Price creates a higher high. We see that we have some type of supply within the market here. All right, looks like demand came into the market with this inside bar here. And we have our change of character within the market here as well. Perfect. So in this area, we have our confluences with our market structure, confluences with our liquidity, confluences with our supply and demand as well. All right, so we can see that price trades down into this demand here, create a failed reaction. Price then takes out that failed reaction with the demand or supply, excuse me, that came into the market here. All right, so this would be entry for a short position. Now, I want you guys to look at something. If we were, oh, is it not working? There it is. If we were taking our entry strictly based off of our M1 time frame, Okay, it tells us to risk around 2.6 pips. On gold, I would never suggest risking 2.6 pips. All right, at least increase your stop loss to 5 pips. At least give yourself around 5 pips of room in order to work with an asset like gold. Now on other assets, especially like Euro USD, AUD USD, okay, yes, you can definitely use 1.5 pips, 3 pips, things like that, but the lowest amount of pips that I would risk on gold is going to be 5 pips. And remember, this is just 1% of our account. So every single time we gain 5% or 5 pips, that is adding 1% to our account profit. All right. Now that we have our entry, let's talk about our take profit method. So take profit, of course, you guys know, is based on M15 swing lows and swing highs. Okay, so for the first entry, okay, more than likely my profit taking would have been here for around 13%, just based on how I trade. Students of mine, those of you who trade exactly like me, you guys actually took this trade and sent it to me. So those of you who took this trade right along, fantastic. Okay, so the first trade opportunity around 13.04%, absolutely bomb. Okay, now let's talk about the second entry opportunity. So if we're looking at the M15, okay, in this area here, essentially we have a higher time frame play at play. All right, so remember, this is also our H4 time frame point of interest. All right, this is something that we pulled off of the higher time frame. So if we don't necessarily want to take an M1 type of entry, okay, using our refined zones on our lower time frame, which is here, then what we can do is we can simply use the less refined zone, which is our gray zone here, okay, for our supply and demand, and then we can look for a higher time frame reaction, higher time frame entry. So on the M15 time frame, here's our sweep of liquidity to the upside here. Okay, we have this break to the downside, price giving us a change in market momentum, as well as giving us a demand failure here with this candlestick body closure below this zone. Oh, let me fix this up with the change of, let's see, there we go. Perfect. Okay, and now you're looking for what? Now you're looking for the M15 supply that was responsible for creating all of that. So in this case, we see price trades into our M15 here. Okay, so let's go down to the lower time frame and look at that area in a little bit more detail. Okay, so in this case, the M5 is actually a little bit more clear in my eyes, okay, just on how price plays out this entire region. So once again, here's our sweep, okay, absolutely beautiful. Here is our demand, okay, that is failed with price taking this level out completely. Beautiful. See if we can refine this a little bit on the M1 though. See if we can have somewhat more of a refined zone within this area. Okay, that's more like it. Okay, so let's go back to the M5. And guys, this is really how day trading is. Like, you're going from time frame to time frame. You're looking at this. You're looking at that. Okay, so essentially we're fine to these wicks here. Beautiful. We have a change in market structure here as well. Fantastic. All right. Now let's talk about our first entry on this time frame. So our first entry on this time frame, let's use this. Okay, is going to be this inside bar here. Perfect. Short position would be here. And once again, so the risk on this, so you would have still been good. All right, price did push up. Maybe with spread you would have gotten taken out, but remember, 5 pips on gold. Guys, there's no reason to have 2-3 pips on an asset like gold. All right, gold moves very, very quickly, so don't be too greedy. Go ahead and put that 5 pip stop loss if the stop loss it's giving you is anything less than 5 pips. Okay, and then we just allow price to run. All right, so in this case, let's see if we at least hit 5%. So we at least hit 5% here. Okay, so remember, once you're up 1 to 4, you're going to go risk-free. And once you're up 5%, feel free to close the trade. Okay, so in this case, target was here. Okay, so I wouldn't have taken anything off of this trade, honestly, after going break even at around 1 to 4. So we can see that was taken out. But what you guys have to pay attention to is your second possible point of interest. Okay, usually when you're taking trades like this, okay, usually you're gonna have 2 points of interest that form for your entry. Okay, you can either risk 0.5% on each possible play, or you can risk 1% on each possible play. All right, so here we have apex supply that came into the market that was responsible for this overall push to the downside. Price taps into this area here. All right, let's see where the stop loss is. Stop loss is at least 5 pips. Okay, 7.79 pips. Okay, so perfect, we can keep it. And then of course we're going to target our week low on the higher time frame. You guys already know how I roll. And really this can be based off of, since this entry was based off the higher time frame, okay, targets would also be based on the higher time frame. Let's go ahead and extend this out a little bit. Drag this down. Make sure we can see it on the higher time frame. Figured it was off. And we'll be looking for target for price to push down towards this low here. This low should be hit, all right, for sure. Now, we also talked about this on our Wednesday night or Monday night webinar with my students. So we were already anticipating this entire move taking place here. So for any student who was able to find a re-entry within this entire area to the downside, remember, we were right up here within this area when I told you guys that price was going to target this low here, all right? So not a bad trade. So total we have, I mean, this hasn't been hit yet, okay, but 35.28%, that's definitely going to be hit. Let's go ahead and write that down. And you guys feel free to come to the charts a little later, maybe in a day or so, and you guys will definitely see that area being hit. So 35.28%, okay, on that trade there. We had 13.0, was it 0.9% on the other trade, on the other entry? And remember, guys, these entries, 13.04, these entries are all entries that I teach within my mentorship program, within my institutional trading course as well, right? Like exactly how I broke down the charts here, okay? This is exactly the information that you should be applying once you go through the institutional trading course, right? Everything's gonna make sense. It's all going to click. I literally give you guys step 1, step 2, step 3, for zone, for finding your zone, and then step 1, step 2, step 3 for finding your entry within that zone. Very, very simple how I trade, right? And then, you know what, guys? We're just going to say minus 1% for, wait, actually, no. We hit 5% on this trade? Which trade was it? Was it this trade? Yes, we at least hit 5%. So we went a little over, okay, but like I say in my mentorship program, if we hit 5% on a trade, that is something you guys should contemplate, okay, taking off the table. So if we look at for the past 2 days of using my trading strategy, and the only reason why I'm going over all of these trades is because I had a student, and I'm pretty sure it was more than one student, but I had specifically one student who sent me all of his entries, all of his percentage gains, and his last trade is targeting the low that we talked about on our Monday night webinar, right? So that's the only reason why I'm going to calculate all of these. Let's see, 3.28% plus 13.09% plus 5%. So you're sitting around 53.37%, okay, on all these trades combined, if you were to just risk 1% of your account per entry, which means you're just exposing 3% of your capital, and you're gaining over 53.37%, right? That is absolutely crazy, but those are the types of numbers that we do. All right. So with that being said, this concludes our entire gold breakdown. I know this video was kind of long, but a lot of you guys have been asking me for, longer videos, more content, more analysis and things like that. Sometimes I forget you guys are traders just like me. I love to analyze the charts and I love to mark up the charts. And it didn't hit me until last week that, as traders, you guys probably want to see the same thing that I want to see. So I'm going to make these videos a little longer for you guys. I'm going to give a little bit more information, explain a little bit more for you guys, so you guys can pick those things up and apply them on your charts. But with that being said, yeah, we're going to be looking for this low to be taken out here. And the rest is history. So yeah, we should see this getting hit pretty soon. With that being said, I'm going to go ahead and wrap this up here. It was around 20 minutes, I believe. With that being said, much love for you guys. Peace out.